The American housing market in 2026 isn't recovering. It's trapped in a liquidity crisis that could last years. Behind the headlines celebrating falling rates, the data reveals a market suffocating under structural problems that lower rates simply cannot fix. Homes are sitting unsold for record periods. Sellers outnumber buyers by margins never seen before. And even with more affordable monthly payments, the gap between what homes cost and what Americans can actually pay keeps widening. According to Redfin's latest market analysis, pending home sales are still down nearly 3% year over year, and the typical home now spends 61 days on the market before going under contract. That's a full week longer than last year, and the longest timeline in at least 3 years. This isn't a recovery, it's a slow-motion freeze. In this breakdown, we're exposing the 5 critical forces keeping the housing market locked in paralysis, and why buyers entering now could be making the biggest financial mistake of their lives. Hit subscribe to Housing Intel for data-driven real estate intelligence that cuts through the noise. The illusion of recovery is everywhere right now. Mortgage rates dropped to 6.06% in mid-January, the lowest level since 2022. President Trump ordered $200 billion in mortgage bond purchases, pushing rates down and bringing some hopeful buyers off the sidelines. Mortgage purchase applications surged 5% week over week, hitting their highest level in 3 years. New listings followed the same pattern, declining only 1.6% year over year, the smallest drop since November. On the surface, this looks like momentum. It feels like the market is finally thawing after years of freeze. But dig deeper, and the picture changes completely. Pending sales are still negative. Active inventory is barely budging. And the homes that do sell are taking longer than ever to find buyers. The rate drop didn't fix demand. It just slowed the bleeding temporarily. The real problem isn't interest rates anymore. It's affordability, psychology, and a massive supply-demand mismatch that cheap credit can't solve. Buyers who rushed in thinking rates would save them are about to learn a brutal lesson. Lower rates don't matter if prices are still disconnected from income reality. Lower rates don't matter if insurance costs are exploding. And lower rates definitely don't matter if you're one of millions of homeowners locked into a 3% mortgage who simply won't sell. The illusion of recovery is masking a market that's structurally broken. This is officially a buyer's market, but it's a buyer's market nobody actually wants. For the first time in over a decade, sellers outnumber buyers by a record margin. Inventory has climbed steadily, with active listings up 1.4% year over year. That may sound small, but it represents the first sustained inventory growth in years. Buyers have negotiating power they haven't had since before the pandemic. They're demanding price cuts, asking for repairs after inspections, and walking away if sellers don't budge. Milwaukee Redfin agent Ben Ambrock confirms what's happening nationwide. Buyers are in control. But here's the twist. Even with all that power, buyers are paralyzed. They're taking their time. They're nitpicking. They're negotiating hard. But many still aren't buying. Why? Because giving up a 3% mortgage rate for a 6% rate feels catastrophic, even if rates dropped from 7%. Because home prices are still at near-record highs, with the median sale price sitting at $378,493. Because insurance premiums in vulnerable markets have doubled or tripled in 3 years. Because property taxes keep climbing. Because the overall cost of home ownership, even with lower rates, is still crushing for middle-class families. Buyers have power, but they're using that power to wait, not to buy. They sense something is off. They feel the market hasn't bottomed yet. And the data backs up their instincts. This buyer's market isn't driving transaction volume. It's driving hesitation. And that hesitation is suffocating the entire market. The most alarming signal in the data isn't prices, it's time. The typical home that sold in the 4 weeks ending January 18th spent 61 days on the market before going under contract. That's 7 days longer than the same period last year and the longest timeline in at least 3 years. 61 days is not normal for a healthy market. It's a flashing red warning sign of collapsing demand. In a balanced market, homes move in 30 to 45 days. In a hot market, it's 10 to 20 days. But 61 days? That's a market where buyers have vanished and sellers are desperately waiting for anyone to show up. And it gets worse. Only 21% of homes are going off the market within 2 weeks, down from 22% last year. The share of homes selling above list price has dropped to 19.7%, down from 21%. The average sale-to-list price ratio fell to 97.8%, meaning most homes are selling below asking price now. Every single metric screams the same message. Demand has evaporated. Sellers are cutting prices, offering concessions, and still waiting weeks or months for offers. Buyers know this. They see the desperation, and that makes them wait even longer, hoping for better deals. This creates a vicious cycle. The longer homes sit, the more buyers wait. The more buyers wait, the longer homes sit. It's a liquidity trap, and there's no clear way out. Subscribe to Housing Intel if you want to stay ahead of market shifts like this. Here's the math that's breaking the American housing market. The median sale price is $378,493. At a 6.06% mortgage rate, the median monthly housing payment sits at $2,441. That's down 6.3% from last year, which sounds great until you look at income. The median household income in the United States is roughly $75,000. That means the typical American family would need to spend nearly 39% of their gross income just on housing. Financial advisors recommend spending no more than 28%. We're 11 percentage points beyond sustainable. And that's before insurance, which has exploded in vulnerable markets. Before property taxes, which keep climbing. Before HOA fees, maintenance, and utilities. The gap between what homes cost and what Americans can afford isn't closing. It's widening. Even with rates at 3-year lows, affordability is still near historic worsts. In cities like Philadelphia, median prices jumped 8.8% year over year. In Cincinnati, up 7.8%. In Cleveland, up 7.1%. Meanwhile, wages in those cities barely moved. The disconnect is staggering. Builders know this. They're slowing construction. Sellers know this. They're cutting prices but still can't find buyers. And buyers know this. They're walking away or waiting for reality to catch up. The market is stuck because the math simply doesn't work for the vast majority of Americans. Until prices fall significantly or incomes rise dramatically, this paralysis will continue. While national headlines focus on falling mortgage rates, certain markets are in full collapse. San Jose, California saw pending sales plummet 32% year over year. San Francisco dropped 29.4%. Oakland fell 24.3%. Houston declined 19.7%. Seattle dropped 19.6%. These aren't minor corrections. These are markets where demand has disappeared almost entirely. In San Jose, the median home price is still hovering near $1.2 million, but local tech workers are getting laid off, and remote work has killed the urgency to live in Silicon Valley. Buyers have fled to cheaper markets, leaving Bay Area sellers stranded with overpriced properties and zero interest. San Francisco is facing the same crisis. The city lost population during the pandemic and never recovered. Crime, homelessness, and remote work gutted demand. Now listings pile up while sellers desperately slash prices trying to attract anyone. Oakland tells a similar story. Once seen as San Francisco's affordable alternative, it's now plagued by insurance problems, crime concerns, and a buyer base that's moved to Sacramento or out of state entirely. Houston's decline is driven by oil market volatility and overbuilding. Developers flooded the market with new construction during the boom, and now inventory has swamped demand. Seattle's tech-driven economy is sputtering. Layoffs at Amazon and Microsoft rippled through the housing market. The buyers who powered Seattle's growth for a decade are gone, and the correction is brutal. These aren't isolated incidents. They're canaries in the coal mine, showing what happens when structural problems collide with local economic weakness. If you're finding this breakdown crucial, Tap that subscribe button to Housing Intel. Here's the hidden force locking up the entire housing market: the mortgage rate prisoner effect. During 2020 and 2021, millions of Americans refinanced into mortgages at 3% or lower. Those rates were generational anomalies, the lowest in modern history. Now, even with rates dropping to 6%, those homeowners are trapped. Selling means giving up a 3% rate for a 6% rate, effectively doubling their monthly interest payment even if they buy a similar home. So they're not selling. They're staying put, aging in place, and removing millions of homes from the market. This is why inventory growth has been so anemic despite rising listings. For every new listing that hits the market, there are 10 homeowners who would normally sell but refuse to because of their locked-in low rate. This creates a supply crisis disguised as a demand crisis. Buyers can't find enough homes because existing homeowners won't sell. And the homes that do hit the market are often from desperate sellers, people forced to move for jobs, divorce, financial distress, or death. Those distressed circumstances mean sellers are more willing to negotiate, which reinforces buyer hesitation. Why rush when every listing screams desperation? The mortgage rate prisoner effect won't end anytime soon. Even if rates drop to 5.5% or 5%, the gap between 3 and 5 is still massive. Until rates fall below 4%, or until enough time passes that life circumstances force moves regardless of rate, millions of homes will stay locked up. That means inventory will stay tight, transactions will stay low, and the market will remain frozen in this painful equilibrium. The 2026 housing market isn't recovering. It's trapped in a slow-motion crisis that lower mortgage rates can't solve. From coast to coast, the warning signs are flashing red. Homes are sitting unsold for over 60 days. Sellers outnumber buyers by record margins. The gap between prices and incomes keeps widening. Major markets like San Jose, San Francisco, and Seattle are in free fall, with pending sales down 20 to 30%. And millions of homeowners are locked into 3% mortgages, removing supply from the market for years. Buyers feel the dysfunction. They have negotiating power, but they're using it to wait, not buy. They sense prices haven't bottomed. They know affordability is still broken. And they're right. According to Redfin data, the structural problems plaguing this market, inventory paralysis, affordability collapse, regional crashes, won't resolve quickly. This isn't a dip that rebounds in 6 months. It's a multi-year reset. For buyers rushing in now because rates dropped, the risk is real. You could be catching a falling knife. Prices may drop another 10 to 20% in vulnerable markets. You could be stuck in a home you overpaid for, unable to sell without losing equity. For sellers, the desperation is setting in. Homes that used to sell in days now sit for months. Price cuts are becoming mandatory, not optional. Yes, and buyers know they have the upper hand. But here's the thing. Armed with this data, you can make informed decisions. You can avoid the traps, wait out the chaos, and position yourself strategically. Knowledge is your greatest asset in a market this volatile. So if this analysis opened your eyes, smash that like button right now. Subscribe to Housing Intel for weekly data-driven real estate intelligence that cuts through the hype and gives you the truth. And drop a comment below. Are you buying, selling, or waiting this market out? We read every single one. We'll see you in the next breakdown, because in 2026, knowing when not to buy might be the smartest financial decision you ever make.